My name is Phillip McGann. I'm the General Manager of Hudson Financial Planning. And one question I get asked quite often by clients and potential clients is, which is better, shares or property? Well, the simple answer is it depends. It depends on the individual. It really depends on what you as an individual are trying to achieve from investing in either asset class. We feel that both shares and property have attractive attributes, but they also have negatives as well. If we look at the share market, it's a very good wealth creator. It's been proven for many years, decades, centuries, that it is a great way to sort of generate wealth over the longer term. It is a very easily, as we say, a divisible investment, meaning you can put small amounts of money into it at a very low transaction cost. It is able to be used leveraged. You can borrow money to actually invest in shares if you wanted to. The dividend return or the yield on the investment is attractive and tax effective. The big downside for shares for a lot of people, and what scares a lot of people with share investing, is the volatility. As we've all seen, you can actually have very wild, volatile days on the share market. You can mitigate this somewhat by diversifying across individual shares and individual share markets around the world, but in its inherent nature, in the very short term, it is a very volatile asset class. So you need to invest in shares for at least 5 years plus. That's an optimal time frame. Conversely, the property market. We believe residential property is a very good growth asset class. It is attractive to a lot of people because it is very tangible. People live in a house or a unit, they can touch and feel it, they know something about it. But it really is an asset class that you need to do well and actually get involved with. It is highly leverageable. Banks will lend you a lot of money to actually get into property. It is a very tax-effective investment class, so you can sort of get some tax advantage from investing in property. The downside for property is it's very high transaction costs. It's very expensive to get into and get out of. It's not divisible. You can't sell a bedroom in a house, so it's basically something that you need to hold for the longer term. And it's very hard to get diversification in residential property, because unless you've got quite a sizable portfolio, you can't add multiple properties, 5 or 10 or 15, to get diversification around the country. So you've got to be careful on that front. So which is better, shares or property? They're both good. It's really dependent on the individual, which one suits you, and it's up to us to give you good advice in that regard to see which you're more comfortable with and which suits your overall circumstances as you put together a financial